As we enter into the budget week, I am here in conversation with Mr. Dhiraj Nim, FX strategist and economist at ANZ Research. Welcome, sir. Sir, my first question to you is how are you expecting the budget this year? For the next 3 months, as it's an interim budget, so what are your expectations in terms of fiscal consolidation path? Because I believe no major announcements are expected for this year right now.
Well, it's right. So it's a vote on account budget, which means that typically these budgets are designed to keep the fiscal wheels rolling until the new government comes in power and represents its budget in July, reflecting its own economic priorities, which means that we are not expecting a lot of tinkering around, the measures about revenue. For example, we don't expect a lot of tax rate changes, so to speak. But, the government will still be announcing a full spending budget, which will reflect, its economic priorities, its areas of growth that it wants to achieve, as well as its thinking on the fiscal glide path, which is, how much of fiscal consolidation in the fiscal deficit can be expected in this year. Now, for the FY24 revised estimates, that is the fiscal year ending March 2024, we expect the government to show that, they will be able to meet their fiscal deficit target of 5.9% of GDP, despite all the risks that we have noticed occurred through the course of the year. But for the FY25 is where we see scope for about a 50 to 60 bp consolidation in the fiscal deficit to 5.3, 5.4% of GDP, not more. So that is my key expectation from the budget.
Okay, so and how do you expect this FY25? How do you see the government is going to meet or fall short maybe of the fiscal deficit target for FY25? How is the fiscal math looking like there?
Right. So on the question of fiscal math, I think there is a need to take a step back and go to the 1st February 2023 budget, when the finance minister had announced that they plan to take a fiscal deficit target to 4.5% of GDP by FY26. Now, if it has to be linearly spread in 2 years, that means ideally the government should aim for a 70 basis point reduction in the fiscal deficit ratio in FY25. But I'm expecting about 50 to 60 basis points, which is somewhat less than optimal. The way I'm thinking about it is as follows. I think the government spending, when you look at the combined spending of states and center in GDP, has become very important. It's risen by about 5 percentage points in the last 3 years and is perhaps at a historical high since the turn of the century. And it's not happenstance. I mean, you have to understand that government spending has become the driver of growth. There is a very significant push in terms of capex as well as developmental spending, which is, benefiting the economy in very visible ways. I mean, India is one of the economies which has emerged from the pandemic with a higher investment rate and has a very solid growth fundamental. So I expect this to continue. I don't see any reason for the government to sharply scale down its spending in FY25, because that would be akin to taking the wind out from beneath the wings, right? Now, where would the capacity then come from to reduce the fiscal deficit? And I think that's where the government should really double down on its efforts of raising revenues. We've seen in the last 3 years that tax collections have been quite buoyant, and more particularly so for the direct taxes, such as income taxes from corporate taxes, personal income taxes, and so on. And I think that's where something positive might be brewing. So I think that, they should aim for better revenue mobilization in FY25, which should create the fiscal capacity to reduce the fiscal deficit ratio without withdrawing the support from growth that it has given to the economy the last few years.
Right. When you say a hasty fiscal retreat may harm in FY25 because the GDP growth is expected to slow down, what do you exactly mean by that? Where are the challenges that what are the challenges that you see for GDP growth in FY25?
So 3 points there. I think the first is that, private consumption expenditure growth is weak. And we've seen that in the GDP prints or whatever high frequency indicator of consumption you look at, it is not portending a very strong trajectory ahead. And mind you, private consumption is about, more than half of the GDP, right? So it's a very important component of GDP. And if it grows slowly, there's only so much the aggregate GDP can grow, right? This is where the government had stepped in with its expenditures, especially on capex, which were growing very, very solidly, giving that overall buoyancy to growth, right? So that's the spending bit. That's the shortfall on account of private consumption that, we expect the government spending to keep plugging to some extent. The second risk is around external demand outlook. Of course, our exports are past their worst. I mean, they have inflected, and that's true for most economies in the region. But we're not very sure yet if this upturn will be a very strong upturn, because the developed market growth is expected to be slower in 2024 than it was in 2023. So there's going to be a measured upturn in exports, which means that external demand conditions will not be a greatly supportive factor for growth, right? And the third bit is on the investment cycle itself. So we've seen over the last 2 or 2.5 years, it's largely the public capex, the government capex, that's been driving the overall investment spending in the economy. Now, we've done some calculation looking at, monthly budget data as well as the GDP data from the quarterly releases, and we figured that that remains the case even until the Q3 of 2023, the last GDP data that we have. There's been a modest upturn in the private capex cycle, but it's not yet consistent or strong enough for us to believe that the India's capex cycle is going to last long in a very strong manner. So we are very hopeful of that happening, but we don't see any signs of that yet. So given these three risks, I believe that government spending support to the economy should continue perhaps for one more year. And it should not be sacrificed at the altar of fiscal consolidation when you have the opportunity of mobilizing better revenues and creating that fiscal capacity that we have not had, let's say, prior to the pandemic.
Right. Because you mentioned about spending, so how does the expenditure profile looks like right now? Because in the report as well, you mentioned that the spending rejig is going to happen from capex to current now. So what is the expenditure profile that you see for the rest of the year?
Look, for the year ending March 2024, that is the revised estimates of FY24 are likely to show this modest spending rejig. And I say that because we know that through the course of the year, there were extensive subsidy burdens that were not budgeted for when the last budget was presented. So I think about 50,000 crore rupees of additional, outgo is going to happen on account of subsidy burden. And that will have to be met, of course, from better direct taxes as well as some cut down from the capex. Now, capex was budgeted at 3.3% of GDP, and we know that the nominal GDP growth is going to surprise on the downside. So even though they may cut, from the nominal numbers, some amount of capex, it would kind of remain similar, around 3.3% of GDP in terms of its share. So from an economic importance perspective, it's going to remain the same, but it's hardly a rejig of about 20,000-30,000 crore rupees here and there. That should not matter in the overall scheme of things. Now, going ahead into FY25, I believe overall expenditures, including revenue as well as capex, could grow in the range of about 7 to 8% over the year.
Okay. When you say better direct taxes right now, because the IMF Fiscal Monitor report has also mentioned that there's a vast divergence between India's revenues from global peers as well. So why do you think that there has not been that good direct tax collection revenue coming in? And what can be done to ensure that there is a higher tax return, tax revenue for the government?
Look, there could be several factors behind, this fiscal impediment that, we've not had very strong coverage of direct taxes as a proportion of the tax paying or the tax eligible pool of people in the economy or firms for that matter. Some of the factors that come to top of the mind is poor compliance because there's not enough surveillance, or the processes are very cumbersome, or the average incomes were lower by themselves. So a lot of these people fell into a bracket where they were not eligible to pay tax or not liable to pay taxes, more so like. And then the fourth factor is, of course, how big this pool was of the people who are actually supposed to be paying taxes. Now, think there have been some structural factors, structural changes, which have been quite positive for this story. And we finally think that, the key fiscal impediment in India, or the constraint in India, that we've had very poor tax compliance, could be beginning to ease. Now, I've done some work on this, and I've figured that, using some statistical tests here and there, we figured that about 20% and 10% of the rise of the indirect taxes and the direct taxes in their annual format between the last quarter of 2023 and Q2 of 2020, that is during the pandemic, owed to factors like improved compliance, right? So that's a significant chunk of money coming from the factors that, were initially not present. Now, this makes us believe that, all these positive structural uptrends, whether it's digitalization or rising average incomes or an expanding pool of taxpayers that we've seen, in the statistics of how many people have been filing their returns, all of them are positive signs for tax collections to grow. And this is where we think the government should really, double down on its effort and try to make the best of it as possible.
Right. One question related to the markets, as in we are expecting inflows to come in FY25, the bond inclusion inflows into GSET market. Wanted to understand how does it going to impact the budget expectations, or how is it going to impact the budget overall? And what is your sense on the market borrowing?
Sure. So look, I think this is perhaps the most important number that everybody's looking for in the budget. Markets are very quick to react to any signs of fiscal indiscipline on the borrowing account. But I think FY25 is going to be a relatively easier year for market borrowings than the years that we've seen recently. And there are several factors behind it. The first is, of course, the fact that, across the board, globally, we're expecting the central banks to cut the policy rates. So the interest rate risk will recede, and the market should take it favorably. For the RBI itself, we think that with the recent slip in core inflation below 4%, the risks of a deeper and an earlier rate cutting cycle have risen. And, that bodes well for bond prices as such, because the yields could go down sooner than we're currently anticipating. That's the first factor. The second factor is, as you said, we're expecting a lot of inflows, the foreign inflows on account of bond index inclusion. I think the broader consensus is about $30-40 billion. And we think that could represent a significant chunk of the possible net supply in FY25. So we think about 15-20% could be digested by the foreign institutional investors themselves. Which means that for the banks and other domestic onshore participants, there would be relatively a smaller pie of the net market loans that they will have to digest than in recent years, in a relative sense. And come to think of it, even the bank's own appetite for bonds may improve in FY25. We think so because, GDP growth is expected to slow, and we think that the loan growth may have peaked as well. So as also indicated by, the RBI data, the incremental loan deposit ratio is falling, which generally correlates well with yields. So yields may come off as well, and bond demand may improve. And we've already seen some of this playing out, in terms of FII inflows and some anecdotal evidence that banks have appetite for bonds improving. So overall, I think, even if the government were to go for a slightly higher borrowing program, I'm expecting about 4% higher gross market borrowing pegged at 16 trillion rupees. I think the market consensus is that it will remain unchanged vis-a-vis FY24, or even could be slightly lower. I think all of that is within the band of digestibility, so to speak. So I think it's fine. It's a good year for market borrowings, and unless there is a sharp miss on the fiscal deficit targets, I don't think markets should take it negatively.
Right. But are you expecting a sharp miss on the fiscal deficit target? Because most of the economists are not expecting that. But if you talk about FY26, what are your expectations there? And again, my first question, are you expecting a sharp miss in FY26? Because then there has to be a balance.
Right. You're right in pointing out that, if we have to hold the 4.5% of GDP fiscal deficit target as sacrosanct, then we have to work really, really hard in FY26 if we don't work hard in FY25. But let me give you an interesting snippet. I mean, you look at the history of fiscal consolidation in India, whether it was right after GFC or during 2002 to 2005 or thereabouts, or in the last decade for the good 3 to 5 years till about 2018, you would realize that the contribution of GDP growth to reduction of fiscal deficit ratio was consistently outstripping that of actual fiscal discipline, that is the cut in the fiscal deficit in nominal terms. This serves as an important reminder that, fiscal discipline and growth perhaps are equally important in leading you to the target of fiscal deficit at 4.5%. So I would hope that, as the government continues to support the economy through its quality spending, and at the same time is able to mobilize revenues with the help of, these structural uptrends I mentioned, improving tax compliance, I think it's creating enough fiscal capacity and enough GDP growth for itself to land closer to the target, if not at it, at FY26. So my bigger hope is that, growth growth is a tide that can lift all the boats, and it does so. And I think that government should not withdraw its support from that.
Right. All right, Dhiraj, I think we are at the end of the interview. It was lovely having you on NDTV Profit. Thank you so much for watching NDTV Profit. Stay tuned for more news.
Thank you.